I'd like to go ahead and bring in Marci Rossell. Hey, Marci.
Hey there. How you doing today?
I'm doing great. Thank you. You must be pretty busy these days trying to make sense of things. But Marci is with us once a quarter. Marci is a leading economic forecaster, former host of CNBC's Squawk Box. And we like to bring her in quarterly to help us kind of navigate, particularly in these very uncertain times. So, Marci, it's great having you here with us today.
Well, it's great to be here. Boy, don't things change so very quickly. I just saw a headline that said, be careful what you wish for with the economy. So last time we were sort of praying for low inflation. We needed growth to slow down. Stock prices were going through the roof, and we just needed it to all kind of back off a little bit. And lo and behold, that's kind of what we got right now.
That's right, Marci. You were back with us in January, and there's just been a bunch of activity, much of it out of our control. It's kind of happened since then. So let's go ahead and dive right in. I know the stock market is not the economy. I mean, they're separate and distinct from each other. However, the market does have a pretty powerful effect on just how people feel about things and how things are working. So maybe you can start with just what is driving the market right now.
Well, I always like to say that markets don't lie, and they are very powerful forward-looking indicators of where the world might be headed. So when you see overall the stock market, take a almost 20% decline, I believe as of today, year to date, we're down 17% for the S&P 500. Of course, as an economist, that's going to sort of make me a little bit nervous because frequently prior to a recession, what you tend to see are stock prices, a few months before one hits, start to take a dive. However, I do think that there's something just a little bit more complicated happening. So while I do believe that sort of the probability of a recession, because of some of the developments we're going to talk about today, has definitely gone up, the stock market is responding, I believe, to rising interest rates and the prospect of the Federal Reserve doing so very aggressively over the course of the coming year. And whenever that happens, you always see a flight to quality. And you always see declines in the most speculative types of investments in the economy. So I brought you guys a chart today because I just wanted to show you sort of what I believe is definitely the most speculative end of the economy right now. And that's been cryptocurrencies. And so this is a chart of Bitcoin. And you can see that the price of Bitcoin stayed fairly stable throughout 2018, 2019. Of course, when the pandemic hit, interest rates declined dramatically. We've been down at zero for 2 years now. And at the same time, we have a tremendous amount of quantitative easing by the Federal Reserve. And you also had a tremendous amount of fiscal easing by Congress. So this sort of, if you think back to 2008, 2009, the last time the Federal Reserve engaged in a lot of quantitative easing, you didn't have fiscal policy stepping up to the plate as well. So we get sort of both things happening. We are now in the process of tightening not only monetary policy, but fiscal policy is tightening dramatically as well. If you think about the $2.5 trillion that was sort of pumped into the economy in terms of income support over the course of 2020 and 2021, this year, all of that is sort of working in reverse. So we've seen the price of Bitcoin decline. We've seen the price of all cryptocurrencies decline. Anything that I would call the most speculative, riskiest sides of the economy, things like venture capital. You're seeing a lot of anecdotal evidence that in the venture capital world, things are getting a lot tighter. And of course, we've seen technology stocks decline more than the overall market. So even though the reports from Target this week and from Walmart haven't been good, those retailers that we think about as being tremendously stable, it's really what's driving things is a big decline in technology stocks as their valuations burst forth during the pandemic, they are now coming back down to earth. And I think this looks very, very similar to what we saw in the dot-com boom of the late 1990s into 2000. So for those of you who've heard me talk before, I'm always looking to history to give us a little bit of a roadmap to how this thing might play out. And I'm thinking that the world today looks very, very similar in terms of how it looked during that dot-com boom that turned into a dot-com bust back in 2000, 2001. And we didn't have cryptocurrencies back then. Back then, we had pets.com and technology stocks, which were sort of, I would say behaving much like cryptocurrencies. SPACs, NFTs, meme stocks are all behaving in this environment today.
Marci, that's great. And, kind of segueing off that and drawing the parallel, you mentioned the kind of the end of the boom, the beginning of the bust. There were a lot of world events, frankly, that were happening at about that same time. So I think this dovetails well in just maybe a discussion around Ukraine and the war and the impact it's having, and maybe even a little bit about China and their lockdown.
Well, if you think about the war in Ukraine, it actually, from an inflation and supply chain issue, it couldn't have come at a worse time. And lay that on top of China's continued pursuit of a zero COVID policy that is bringing them the kind of lockdowns that mean that I saw a statistic the other day that the demand for oil in China is down 6.7% this year. So they are living through a dramatic sort of shock to growth to their economy. And I think this will prove in some ways, the world it's going to take a while for us to get our minds around what happens when an economy like China, which has been growing ever since they joined the WTO back in 2000, basically, what happens when an economy like that starts to slow? But I am actually of the opinion that the Russian-Ukraine shock to energy markets, the worst of that is probably over. And that if you think about where inflation is likely to head in the months ahead, we know that Russia is managing to divert its oil to China and India. They are both going to buy oil at a discount, around $70 a barrel from Russia, which means that demand from China and India for the rest of the world's oil will actually decline. And so I think we have reached the peak for oil prices. It has to do with deflationary pressures coming from China, but also the US rig count. So I brought another interesting slide here that I look at very, very closely. Oil prices and the US rig count tend to move in tandem. Now, the rig count just tells me how many oil wells are pumping in the U.S. economy at any given time. And you can see from this chart that goes all the way back to 2015 that that oil prices, when the rig count is really high, that tends to drive oil prices down. But as oil prices fall, rig counts tend to go down with them as well. So you can see that back in 2020, when oil prices went negative, the rig count in the U.S. went from 800 all the way down to 250. Now, it takes time to bring U.S. supply back online. But you can see from this chart that we are about 100 wells short of being back to pre-pandemic levels of U.S. production. So U.S. production gets back to pre-pandemic levels. That's consistent with oil at about $70 a barrel. Now, it's going to take us at least 10 weeks to get there, but I am of the view that supply issues are the worst is behind us when it comes to energy markets. Now, when it comes to food prices, that's something completely different, because we woke up after the invasion of Ukraine to the realization that Russia and Ukraine together account for 25% of wheat exports. And while this will be an inconvenience in the US, as we pay more for bread, as we pay more for pasta, as the Atkins diet begins to look much more attractive for many Americans, when you look outside of our borders in countries where people spend a greater percentage of their income on food, places like North Africa, parts of Asia. In places like that, rising food prices will be devastating, and they will also be geopolitically destabilizing. The last time we saw a spike in global food prices, it coincided with the Arab Spring. So when food gets expensive for people who are at subsistence level living, you see geopolitical turmoil accompany that. And so I think there will be broader implications worldwide for the spike in inflation. From an economic point of view, for the US economy, it won't feel good, but it won't be nearly as debilitating and disruptive as it has the potential to be in a place like Peru or Sri Lanka.
So, Marci, you just hit on kind of the elephant in the room, inflation. So, I think inflation's rising. Some say it's peaked, it's peaking. I think people expect now it'll just come down over time. So I don't know if it was early this week or maybe last week, former Fed Chair Ben Bernanke actually was quoted as saying, we may very well be in a period of stagflation. So maybe you can kind of comment on that and help us understand a little bit more.
Well, stagflation in the traditional sense, and the type of stagflation that we experienced in the 1970s, was a period of high inflation. Back in the 1970s, it was over 10%. We haven't hit those numbers yet. We sort of, I believe, maxed out at about 8.7% year over year. In the 1970s, every year, inflation was coming in at about 10%, and it was unrelenting. At the same time, you had high rates of unemployment as well. You had unemployment in the early 1980s reach 10% and kind of hang out there after that recession. So Bernanke, however, I think he's referring to something that could be much more short term in the second half of this year, where inflation rates as measured by year over year inflation remain stubbornly above 5%. So even though inflation is likely to come down, it's going to take over a year to get back to the 2% level. At the same time, supply constraints and shifts in consumer sentiment, those two things mean that growth will take a step back. Now, I don't think it will hit employment. The unemployment rate is 3.7%, and you still have millions of openings in the economy. But I do think you could have this strange situation where prices remain high, yet growth in the U.S. economy pulls back just a little bit. I don't think you're going to see an outright recession. If you do, it will be very mild. But I do think that in terms of using the word stagflation, it's going to look like a mini version of what you saw in the 1970s, but nowhere near to that degree.
That's great. Thank you, Marci. I want to bring in Barry for a second here. I know he had some follow-up questions, particularly how it impacts everything you're talking about, our members and their clients. But Barry.
Hi, Marci. Great to be with you again. You just sort of, made a comment about a recession, and if you said, might not be that big of a recession, or maybe not that big of a feeling. Our members, and many of them, 10,000 of them or so, every town hall, really work with small business in a lot of ways. Some of large business on here too, but they work with them. Either they work for them or they're their clients. And I think, the trusted advisor notion that we have sort of worked with you on, and we certainly were a big player in, and as we got into the COVID situation, what's some practical things they should be opening up this discussion with their clients on, particularly as it relates to the risk associated with a potential recession, even if it's mild? What are the real key industries? What are the key points that they should, in this trusted advisor role, be putting on the table with either their bosses or their clients that are the entrepreneurs?
Well, I think that I sort of recommend to people all the time, you always need to be stress testing your business model for higher interest rates, because that's the world that we're living in right now. So thinking that we're going to go back to capital being essentially free, That's not going to happen anytime soon. So can you live in a world where short-term rates, on a 5-year note look more like 5 or 6% instead of 3 to 4%? Can you live in a world where mortgage rates are between 5 and 6% as opposed to 2 to 3%? So that is the first thing. But also, I do think it's important to remind people that, again, we have a roadmap from history. And for those who have been in business for over 20 years, they remember the late 90s and the early 2000s, the last time we saw a situation like this. I'm not expecting anything like 2008, 2009, where credit conditions seized up, because you haven't had all the speculative lending over the course of the pandemic that you had leading up to the last great recession. So we find ourselves in that sort of late 90s, early 2000s situation where if you are connected to the tech industry, it's probably going to be tough. But if you've struggled to find talent over the last 2 years, I expect labor markets, or the balance of power in labor markets, which has been so rough for about 18 months now, it's about to get a little bit easier to find staff, because we know that there are hiring freezes in technology. And in some instances, there are even smaller venture capital related technology firms that are actually laying off workers. So we're sort of at the beginning of that. And I think some of the stresses that small businesses have been dealing with, supply chain issues, you can't get parts, all those things, they are turning very, very quickly. And some of the conditions for these businesses are actually going to ease over the next 3 to 6 months.
So let me just follow up on one that we really haven't gone into detail on, and that's the housing market. Obviously, everybody always focuses on the housing market, and frankly, a lot of the clients that people who are in public practice on this town hall are going to have touched the housing market in some form or fashion. And so, what do you see in the housing market, given sort of this tightening up a bit, obviously interest rates being higher, and certainly throughout COVID, the housing market was, particularly as there were flight out of big cities and stuff, the housing market was a pretty rich part of our economy.
Sure. And in some places, like for instance, Sarasota, Florida, over the course of the pandemic, prices were up 50%. And anytime prices go up like that, everybody sort of remembering what happened in 2008, 2009 gets a little nervous and says, hey, are we setting ourselves up for another bust? And I don't think so, for a couple of reasons. Number one, you don't have the leverage that you had back in 2006, 2007, going into the financial crisis of 08, 09. Lenders have kept their standards very high. You don't have the no-doc loans. You don't have the variable interest rate loans that you had back then. Only 15% of mortgages in the United States are variable rate mortgages. So you don't have a lot of homeowners that are extremely vulnerable to rising rates if they already have a mortgage. By the way, that is not true in a place like Canada. It's not true in the Scandinavian countries. Many of their mortgages are adjustable rate, which leaves them very vulnerable to rising rates. And the other thing, people have been buying homes not because they expect the value to go up, but because you have so many millennials who are starting families, who need a house, want to put a roof over their heads. And all of that means that the demand has not been speculative for new homes. It's actually been very, very real and grounded in fundamentals. Now, I don't expect prices to continue to go up in the year ahead the way they did before, because we finally have some evidence that housing supply is beginning to catch up with demand. So that's a recipe for much more normal housing markets. And so for those of you who have those millennial kids who are dying to get into that first home, who've been priced out of the market, outbid, don't have the cash, those are the buyers who actually stand to benefit from some of the heat coming out of the housing market that I expect over this year.
And I would suspect on the construction side of housing, because supply chain has been a big part of that as well, the high price of lumber originally, but then even a appliances and all the things that go into new construction. So that might actually get a little bit more normalized than from where it was. Is that right?
We know that that's happening. If you sort of dig down into the sort of results from Target that sort of roiled markets over the course of this week, where they said, hey, we have rising inventory, we have tighter, smaller profit margins than we expected. What's not moving any longer are refrigerators, appliances, all those things that we've been dying to get our hands on. So we have some evidence that supply chain is loosening up. Automobile manufacturing was up 3.9% last month. So across the board, anywhere there were supply chain issues, except when it comes to food, right? So we got problems with eggs, we've got problems with wheat, but when it comes to all those things that we import from China and from all over the world, there is some evidence that because Americans in particular are going back to spending money the way they did prior to the pandemic, more services, more travel, more events, and they're less likely to be remodeling their kitchens, less likely to be in the market for a boat, an RV, all those things. As we go back to spending our money the way we did prior to the pandemic, that has a ripple effect all the way across supply chains in much the same way that it rippled in a negative way for the last 18 months.
And one last one, I'm going to cheat one more while we have you. Just a little bit on employment. You touched on that, and it's obviously on everyone's mind in a certain degree. I mean, you have certain factors of coming out of COVID and sort of the challenges of the world, people maybe racing to retirement a bit earlier. You have, from our profession standpoint, human capital supply at the entry level, more than 1 million less students in colleges and universities, even a higher percentage lower in the community college systems. And you did talk about like tech employment, and you may be able to find people in the tech space better because of some of the macro things that you discussed. Any other thoughts on the overall the employment market? Because clearly every business is facing the significant challenges on those low unemployment numbers, and really the attitude to work that has shifted as well.
Well, part of the sort of attitude to work, that balance of power between employers and employees that shifted so dramatically during the pandemic when the unemployment rate has gotten so low, I think some of that's going to ease off. I think that just like I think inflation has peaked and it's coming down, I think the balance of power in favor of workers has probably peaked as well. As you start to see certain industries curtail hiring and maybe even lay workers off, all it takes is a little bit of that to improve things from an employer point of view, for things to kind of get back to normal just a little bit, where, you know, people are actually going to have to show up for work and continue to show up to work to simply keep their job. So I do think that a little bit of sort of growth pulling back is going to improve that situation as well. But in terms of baby boomers retiring, they're going to keep doing that, my friends. And in terms of sort of not being enough young people born to replace all those millennials that are moving into their mid-careers, that's a demographic trend. And demographic trends take 18 years to change. So Barry, you're not going to be around for that. I'm sure not going to be around for that. None of us are, probably. 18 years, long time from now. I hope to be fishing in Florida by that point. So it's not going to be. Probably
if you can afford a house in Sarasota, you mean.
Exactly.
Well, I would say, Marci, you know, I think if people sort of tuned in today and they said, "Oh my goodness, we're going to hear an economic update." I mean, if you sort of summarize your points, well, you know, if we have a recession, it might not be that too bad. Inflation's probably peaked or is not going to really be as big of a problem. Housing sounds like it'll be okay. Energy prices, it'll take a little bit for the rig count to get up, but energy prices are going to probably stabilize, maybe come down. I think you were just sort of this grand presenter of positive, or at least reasonably positive news.
Yep, because when I take the positive approach, I'm right about 95% of the time. That's better odds than blackjack. I'm going to go there.
Hey, Marci, this
was better odds than fishing, by the
way. Marci, this was fantastic. Really appreciate having you on, and we will see you again in about 90 days or so. So thanks again, and hope you have a